Okay, well, it's great to see everyone joining. Thanks for everyone that's joining from all across the country. We have a fantastic discussion plan this evening, led by some of the most highly esteemed and greatest minds in the alternative funding space. I actually had the privilege of getting to host the same group of brilliant people about a year ago for our first iteration of this discussion, and have had the privilege of working with at least half of them in a number of ways. So I can definitely assure you it promises to be extremely insightful and valuable, no matter where or on what side of the table you sit in the fundraising landscape. That being said, we do have a lot to get through, so let's jump right in. So we will be your moderators. I promise that is me. I do not look the same as my picture, but do any of us after COVID. I also want to introduce my co-moderator and colleague, Casey Estrada, who I've had the privilege of working with for the last 5 years, both at Lighter Capital and now at Founders First. We together are your investment team, and we'll be leading the discussion today.
Hey, everybody. Excited to discuss revenue-based financing with everyone.
Great. Thanks, Casey. So I will quickly skim through this agenda to just give everyone a sense of kind of where we'll be taking you today, what we'll be covering. First, we would really like to set the stage with just a general background of revenue-based financing, use cases, competitive landscape, et cetera. And then we'll give each of our experts the floor to dive into their specific offerings, success stories, et cetera. And then we'll hopefully leave a good amount of time at the end for some Q&A. Please feel free, as our host said, feel free to drop any questions you have along the way into the chat, and we'll do the best to answer them if they haven't already been addressed throughout the course of the presentations. So without further ado, let's meet our subject matter experts, who we will be hearing from in more depth a little bit later. First, we have Wayne Cantwell. He is the co-founder and managing director at Decathlon Capital Partners. We also have our very own fearless and a formidable leader, Kim Folsom, founder and CEO of Founders First Capital Partners and Founders First CDC. We also have Keith Harrington, the co-founder and COO of Novel Capital, BJ Lackland, the current CIO of IBI Spikes Fund out of Israel, as well as the former longtime CEO of Lighter Capital. And last, but certainly not least, we have Melissa Withers, the co-founder and managing partner at RevUp Capital. So as if it doesn't already speak for itself, we are very, very fortunate to have this amazing group with us today. All of our speakers come with extremely unique knowledge and experience in the alternative funding space, and specifically the RBF space, that makes them the very best subject matter experts to dive deeper into this conversation with us. I will now pass it over to Casey to give us some foundational context and background on our topic today.
Thanks, Bella. Yeah, well, revenue-based financing. So it really fills a gap, provides much needed alternative for businesses that are unable to find affordable debt options, traditional debt options, or are unwilling to give up equity required, say, for an institutional investment. So on one side, you have debt options like banks. They're going to require collateral or merchant financing that can be very costly in the long run, even though it might provide quick access to capital. And then on the other side, of course, equity investments that require complex diligence processes and additional dilution. Revenue-based financing sits right in the middle as an alternative or even a complement to these traditional financing options. So let's go over some highlights of the revenue-based model. For one, limited financial covenants. Payments are directly depend on the company's performance. As mentioned, no loss of control. Aligned interests. So a revenue-based finance provider, their return will depend on the performance of the business, meaning, the lender does well when the business does well. Advice, and this is really investor specific, but many revenue-based finance providers are here to help and support the growth of the business, kind of going back to the aligned interest there. And then, of course, as mentioned previously, founders retain value upon their exit because there's no additional dilution and typically no equity components. The business owner is able to retain a greater amount of the proceeds of an exit. And let's take a quick look at the structure of RBF. I'll go over a more detailed example later, But at a high level, revenue-based financing can provide businesses up to $10 million of growth capital. That's just a general snapshot among the landscape of revenue-based finance providers. The funding amount is based on a multiple of existing revenue levels. And the return is based on a repayment cap of the funding amount. Again, this is a fixed and capped amount. The investment is repaid via an average royalty percentage of monthly net cash receipts or customer sales on a monthly basis. And then the obligation ends once the repayment cap has been reached.
Great, thanks, Casey. Then just walking through a quick history of RBF. So I know it's really gotten a lot of momentum in the last 20 years or so, or 10, 20 years, but it's not really a new thing, unlike a lot of people understand. So its roots do go back a lot further than the last 20 years. In the early 20th century, actually, we saw variations of royalty-based financing in some version, actually being used to help finance the oil and gas industries. A bit later, we also saw it being used in the pharmaceutical and the Hollywood industries. And then the first signs of it really being used to help grow early stage businesses as kind of an alternative funding source was actually really in the 1980s. And then just in the last, as I said, 15, 20 years or so, we've really see it become kind of a household option that we're still working on getting the message out about. So in terms of, in terms of where people like RBF providers sit in the capital market landscape, I know Casey went over this a little bit, so I'll try to speed through here. Really as this risk versus reward model shows, there's these two traditional sides of the market, things like banks, SBA on one side, and then the more institutional equity-based financing on the other. And where we, along with other types of alternative financing, tend to fit is really in this middle ground, or we sit in the middle ground. Whereas compared to banks, RBF is typically going to be much more flexible, much less restrictive in the way that we lend. Not only is the process going to be typically a lot quicker with a lot less red tape, but we're also not going to base our investment off of the value of your house or your car, your credit score, firstborn children, all of that kind of stuff. We are also not going to have any restrictive bank style covenants on most of our loans. So it becomes a very entrepreneur friendly option where our interests are very aligned. We also are going to have oftentimes different investment theses, enabling us to look at certain businesses, business models, financial metrics, et cetera, that a lot of banks can't look at or maybe are too early for. And then arguably the most important is the repayment model is really going to be variable, directly tied to the company's revenue and ongoing performance. So the better that they do, the better that we do. The interests are always going to be extremely aligned with our portfolio clients, making it a real partnership. And unfortunately, that's not necessarily something that can often be said about some of the other alternative financing options in the space, which we'll get a little bit more into what else goes into that middle ground that we're illuminating here. And then, of course, quickly compared to the other side of that spectrum that is laid out, we're fully non or minimally dilutive. We really want to allow the founder to retain the ownership while still having access to affordable and meaningful growth capital to do so. In this way, we really can act as both an alternative funding source, but also a complementary source, where in many cases, we're also coming in alongside things on both sides of that spectrum. So we will definitely work well with banks and equity and act as a diversification in the capital stack to help the company grow in a number of different ways. So let's quickly just talk about a few of the use cases that we typically see with this type of fundraising. So as mentioned, revenue-based financing is often going to be, or always will be, a lot cheaper and faster compared to equity. Companies can use this non-dilutive capital or non-dilutive facilities like this to help accelerate their growth, improving their valuation either in lieu of, before, or in between conducting formal rounds, all while retaining that valuable equity in the process. This type of long-term growth capital also can be used for a ton of different initiatives. All typically are going to be under the umbrella of things that further the company's growth. We have a very agnostic sense of what that means. We're not, again, an equity partner that's going to be sitting on the board telling you what to do with your operations or precisely with the money. We just want to see, whether it be launching a new product, expanding into new markets, making key hires to support ongoing demand, acquiring assets, books of business, IP, all of that, really just to capture an opportunity within a greater market segment is really all we care about. So then quickly circling back to some of the other alternative funding sources that we mentioned, just wanted to give you guys kind of a visual of taking all this into consideration. What are some of the things that we see that are maybe trying to mirror what we're doing, but not in the same way?
Thanks. Yeah, just wanted to highlight a couple of differences here because, from a 30,000-foot perspective, revenue-based financing and merchant cash advance might appear similar. And in some aspects they are. But what we see in the lending landscape is somewhat of a mismatch that tends to get businesses in trouble because their use of funds doesn't match their capital sources. So revenue-based financing can provide businesses an additional option when perhaps their only options available have been some type of merchant financing. And there's definitely a time and a place for merchant cash advances, but they should be seen as quick solutions for short-term cash flow problems. Revenue-based financing provides capital for more longer-term needs. So typically, MCAs or merchant cash advances will provide a lower amount over a shorter payback period, but with similar total repayment multiples as, say, revenue-based financing. Again, the pros balance out the cons, so long as the business can avoid falling into the cycle of relying too heavily on MCAs. Some of those listed here, right? So MCA application process is easy and streamlined. You're able to get to fast decisions, typically no collateral needed, and they're not relying on personal credit scores. Again, this comes at a higher cost in financing. Again, more of a temporary solution to short-term business problems. And the funds can be repaid weekly and sometimes even daily, creating additional cash flow issues for the business. And so how does that differ from revenue-based financing? Well, again, revenue-based financing will typically be able to provide higher amounts over a longer period of time, and with that capital being used for longer term needs. So as an example, perhaps a business is doing about $1 million in annual revenue, and a revenue-based financing facility might look like $200,000 with a maturity of 3 years, 36 months. And then that is for a monthly payment rather than a fixed dollar amount like a car loan or a mortgage. The revenue-based financing lender will take a 5% royalty of the monthly revenues. This means if there's seasonality or a lumpy payment cycle, that payment will fluctuate along with the cash flow of the business, so that in the bigger months, yes, the payment will scale up, but on those leaner months, that payment scales down as well. Again, the idea being the revenue-based financing is a minimal burden on the cash flow as possible.
Great, thanks, Casey. So now, all that being said, we'd love to hand it over to our experts to give us a little bit of an overview about their firms, their background, what they're working on, and some of the success stories that they've seen work really well with RBF. So first up, I will hand the mic, so to speak, to Wayne over at Decathlon.
The virtual mic.
Yeah, here you go.
Thanks, Bella. Well, thanks everyone for joining. My name is Wayne Cantwell, as Bella said. I was co-founder of Decathlon. We're, I think, approaching year 12 at this point. Had about 10 years of venture capital experience prior to that, and was an operator of public companies and private companies prior to that. When you look at where we're at today, we're roughly 600 million under management. That's growing to probably about 800 over the next couple of 3 months. Our portfolio is 230, 240 companies across a very large set of industries. Software is about 35%. Healthcare related is maybe 10 to 15%. Food, beverage, and alcohol is another, mid to upper single digits. Consumer products, maybe 5%. And then a whole grouping of other companies that do great things and grow and are profitable, but don't fit nicely in the other buckets. Our investment size minimum is about $1 million. We certainly can go up to 10, could even go up to 12 or 15 if needed. Obviously that's based on the size of the company. But basically today we're probably a little ahead of this, maybe 40, 45 deals a year. So we're very active at any given time. There's, I don't know, somewhere between 6 and 10 term sheets out in the marketplace working their way through. And, historically we've done, let's just say over the life of our history here, we've done anywhere from, 4 to 12 deals a quarter, sort of the range. And it's just interesting because obviously there are peaks and cycles, but generally speaking, it's all been kind of going to the right in terms of bigger. What did I miss? The microphone or camera's in the way, but I think I caught all of that stuff. The interesting thing about it is that when we started, along with BJ, who's on here, revenue-based financing seemed to be mostly in pharmaceuticals and mining and movies. And certainly it seems every day now I get an email about someone trying to sell me some market research about how great RBF is and how broad it's become. So it's when you have all the market research firms writing papers and trying to sell you on them, it's moved up a bit in terms of its sort of strata. But I can say this is it's still a very small percentage of the overall growth capital for small businesses. So I think there's a lot of room to grow. It's a great solution. Doesn't solve everyone's problems. It doesn't replace a $50 million equity round. But at the same time, if you're a profitable company or getting close to that and you're growing 20, 30%, it can be a great way to grow your business without any dilution, as all the things that Casey and Bella and everyone has said. And as such, I think this will be a continued growing sort of strata of the growth capital market for many years.
That was great. Thanks, Wayne.
Before we move on, I just wanted to verify, Wayne, on here, it says on your ideal customer profile, years in business 12 plus. I think that was about your own business. What about the customers that you're working with?
Oh, in terms of, yes. So basically, I see it's kind of covered up down there. So we rarely do any deals with any companies less than 5 million of last 12 months revenue. That's kind of our bottom end. Maybe a SaaS company doing 4.2 million or something could get into that funnel, but generally about 5 million is on the small end, and we have companies north of 100, 150 million in revenue as well. So, but the sweet spot for us is, I call it sort of 5 to 20 is the vast majority of the deals, and for in terms of on an annual basis. That's in terms of revenue. In terms of check size, as I said, we can go from 1 to 10, but I don't know, 2 to 4 is the most typical. Every day, every month gets done.
Great. And do you ever work with other lenders, Wayne, in the same rounds?
Probably the only thing that occurs every now and then is the companies may have some accounts receivable financing. There could be an ABL in certain type industries. So, we would line up with those folks as part of the solution. Some industries like food and beverage, you pretty much can't be successful without some sort of receivables product. And we're not a receivables product, we're a long-term growth product. And so for that part of the market, you almost have to play well with others. But 60% of our deals were senior. The other 40% happen to be people who have most typically some AR or occasional AR and ABL.
Got it. Okay. Thank you.
Yeah.
Great. Well, next up, we have our founder and CEO, Kim Folsom, to talk a little bit about what we're up to at Founders First.
Well, hi, and thanks so much, Bella and Casey. I'm so delighted to be here, and thanks to Wayne and Keith and Melissa and BJ for our second time around educating the market about the opportunities for revenue-based financing. Similar to Wayne, I was an operator. I founded 6 tech venture-backed companies. And, I wish that I would have had the opportunity to know these guys when I was running my tech companies for many of the benefits that was mentioned. So it was that operator's journey that led me to launch Founders First. So we've been around since 2015, and specifically, we're focused on the gap in access to growth capital for diverse-led businesses, specifically those businesses led by women, people of color, military veterans, LGBTQ, and those in second and third tier cities, so that you can get access to capital regardless if you are in Minneapolis or Georgia or any of those various areas. And again, on my journey launching my first business, it took me 8 years to launch my first business. And so being able to get access to flexible capital that I get to grow and not have to give up too much equity is a good thing. So with Founders First, additionally, our typical deal size is about 250,000, but we do follow-on fundings as well. And additionally, we recognize that many of our business owners, especially because of the size of companies that we work with, they may not be yet ready. So that's where we have our accelerator side that provides programming to help them be fund ready. But for those businesses that are, we focus, our typical business is generating between $500,000 to 10 million in revenues, service like manufactured or tech-enabled service-based business. And we provide them with also post-funding entrepreneurial support. Some other flexibilities that we also have is we work with businesses that may be in business, just over 12 months as well. If they can show some track record and stickiness with regards to their revenues, strength in revenues, that we will definitely take a look at how we can partner with them. And our goal is to, when we work with these companies, is to be their growth partner and help them grow. And we do play well with others. We've done syndicated deals with other revenue-based lenders, as well as we work with equity firms as well.
Great. Well said. Thank you, Kim. You guys are just speeding through. I love it. We're gonna have a lot of time for questions. Okay, Keith, you are up. You have the floor.
All right, great. Well, I'm a bit of a talker, so I'll slow us down.
Good.
Yeah, no worries. First of all, thanks for having me. This is, as everybody said, the second time around for this. I had a great time doing this last year. I love spreading the word about RBF. As a matter of fact, in my off time, I actually send out a newsletter about RBF and interview other RBF investors, trying to get the word out to other investors so more and more of these RBF funders can launch. So this is a really important topic to me, and one that I'm excited to talk about. So a little bit about me. I have a pretty broad background. I've been a part of hyper-growth startups. I've been a part of very slow growth startups. I've been in big companies, and right before I launched Novel with my co-founder, I was a VC. And really, Novel is the result of the experience that I had as a VC, where I kept having these frustrating moments where I had to say no over and over again to founders who were building businesses that I thought were super interesting. So I would have a conversation with a founder that went something like, "Hi, I have $1 million in revenue. I'm growing 30% year over year, and I need growth capital." And my response would inevitably be, "Well, I'm sorry, but I can't help you." And I saw so many of these businesses and so many of these founders who I wanted to work with because they had fundamentally strong businesses, but they just didn't match the capital that I had in my toolbox. But I eventually got to the point where I was like, there's got to be a better way, right? There's got to be a better way to provide more capital to more entrepreneurs out there. And so I went out and tried to find a way, and I ended up landing on revenue-based financing. And I ended up partnering with another gentleman here in Kansas City who had the opposite experience from me. He was an entrepreneur talking to guys like me. He had a business, an ed tech business with $1 million in revenue. He was growing at 40%, and he could not find anybody to help him grow. And eventually he bootstrapped that business to the point where it was he was able to get some private equity money after running it for 12 years and ended up selling the business after 15 years after he founded it. And when he came out of that experience, he was very much on the hunt for a way to fund more entrepreneurs. So it's been a really nice co-founding partnership, and I think we've been able to do some pretty exciting stuff. So at Novel, we are obviously a revenue-based financing investor. We've provided funding now over 100 times to more than 70 companies, continuing to add more and more customers to our customer set. Alongside the capital that we provide, we actually provide analytics, we provide advice, so that they can help really zero in on what are the things that they need to do to grow their business. So we have a very particular point of view. We think basically sales and marketing is really where we hang our hat. We really want to help entrepreneurs master their sales and marketing growth machine. That's just really where we know everybody wins. And kind of like Kim said, our mission is really not just to deploy capital, but we really view ourselves as a growth partner. So we will commit money to a company, and then we will continue to deploy additional money. We will make additional capital available over time as that company grows. So we view what we do as a very long-term relationship with the companies that we fund. In terms of our ideal customer profile, we are typically funding B2B software and technology and services businesses that have predictable revenue. Doesn't have to be, strictly speaking, recurring SaaS revenue. It can be reoccurring revenue. It can be a predictable revenue stream. It can have as long as it has a pattern to it, we can typically get comfortable with it and provide money. At a minimum, we look for companies to have $500,000 in annual revenue. We like for companies to be growing at about 30% year over year, and we can fund up to about 30% of that company's revenue stream. So if you're $1 million company with $1 million in revenue, we can write a $300,000 check, generally speaking. We write checks anywhere from $100K up to $5 million. And so there you go. That's me, and that's Novel. Hopefully I slowed it down enough. Is that enough words?
That was perfect. Thanks, Keith. Great. Now we have BJ Lackland.
Hi, everyone. Like a lot of folks here, my background is a mixture of, being an operator and growing startups to being a capital provider as a VC, as an alternative provider, as a CFO of a public energy tech company for a while, a CEO and a founder before and such. And like others, came to revenue-based financing in part because I just felt a need in the market for there to be an alternative to super high risk and hard to raise equity and low risk, low yield debt. And so it started around the time that Wayne did. I think Wayne beat me by about a year. I think I've just entered my 11th year of doing RBF and have completely lost track of how many deals I've done at this point in time, somewhere around 700 in the different organizations that I've worked with. Certainly not doing that myself, much with teams, obviously. Anywhere from 50K on the low end when in my earlier days, the CEO of Lighter Capital, up to 5 million or so as recent deals we've done at the current fund that I'm Chief Investment Officer of. So that brings me to the current fund I'm at, is RBF fund based out of Israel, a sort of an experiment, frankly, that they started with some founders there to see if we could really get RBF to work somewhat like it has in the US, as a lot of the people here are doing it, in an international environment. And Israel is a place that's got a lot of deep tech. It also has a lot of VC, but it does not have a lot of non-dilutive options. And so we began the fund about 18 months ago, made our first deal in April of 2021. We've now done 19 deals to 16 companies. We've even started having a little bit of follow-on funding. First couple of deals were a little bit smaller, several hundred K, but all the deals we do now are 500K minimum up to about 5 million. So that ranges from a company doing, a couple $1 million in revenue, and all the deals that we do are for companies that are doing some sort of tech and R&D by regulatory reasons. So we were focused on that in Israel. But we've done deals with companies that are anywhere from like $1 million or so in sales up to a $5 million RBF deal we did recently for a company just under 50 million in revenue. Companies that are totally bootstrapped and have never raised any equity, but also companies that have raised 70 million in VC. So very broad across the spectrum of sponsored and non-sponsored. Longer term, we plan on expanding outside of just Israel, but so far we're still in our early innings and just getting the first money out the door and the portfolio built and seasoned. So we'll eventually expand outside of that. But I think that the unique thing that I, in my experience, bring here, at least with the IBI Spikes Fund, is seeing a bit of an international lens on RBF and seeing that happen. I think we've all, I'm sure, seen the announcements of quote RBF providers launching in France and in the UK and things like that. I think a lot of those are actually more towards the merchant cash advance side of things in terms of their structure, whereas we're trying to do something that's really truly more long-term growth capital, that version of RBF.
Thanks, BJ. Okay, last but not least, we have Melissa to talk about RevUp.
Thanks. I will try to find something different to say, but pretty much we have covered it all. Not unlike others on the panel, I came to revenue-based investing after being an equity investor and a founder, ran a seed stage portfolio, did about 100 companies, found myself really frustrated by the dependency on exits as the only way to win, and didn't enjoy the constraints that put on me as an investor. I found myself focusing more on creating investor-centric companies and being myopically obsessed with exits rather than business building, which is what I wanted to do. So in 2015, raised first fund and feel very lucky to have stumbled upon, at the time, back in 2016, we started investing. There really weren't that many models, and borrowed a lot of things from folks that were ahead of us. Probably the most interesting differentiator for us is we are probably the lowest transaction volume investor on the call today. And that's on purpose. So we've done almost 50 investments since we started, but intentionally only deploy about $5 million a year. And as such, only invest to 8 to 10 companies. And partially that just reflects my preferences and the preferences of my partner. But we provide a super high level of strategic touch, both in terms of practical support on the market facing side and in the C-suite. And for better and for worse, our model just is not high transaction volume. It's more of a boutique portfolio approach. I don't think that's good or bad. It's just probably the thing that makes RevUp a little bit different than some of the other funds that people heard from today. Our average deal is $500K. I can go lower, though. At that, it's hard today to even everything's more expensive. So our average deal is about $500K. We do have a pretty unique growth platform that's been part of our model since 2016. We've got a group of full-time employees for the fund that we deploy to each investee for 12 months post-investment in tandem with our cash to serve as a literal extension of their market-facing capability. That's the work that we love to do, really trying to help companies kind of get up that $1 to $10 million curve. For us, ideal investee, investing into companies that on the very low end have about $500K in revenue. Most are coming in between 1 and 2, any kind of structure, but typically companies that are less than 5 years old, partially because if you've been at it for that long and you're sort of stuck at that $1 million in revenue, then we may not be enough to break you free. And as a revenue-based investor, so much of what we need to kind of figure out when we're deciding if we want to invest into a company is, do we think that they have the capacity to make their way up that growth curve? For me personally, as the first person in my family to graduate college, having been both a founder and an investor at a time when the world was pretty unwelcoming to anybody that was building their business outside networks of privilege, about 70% of the investments I've made since 2018 have gone into companies that are either led by a woman or a person of color, or a founder that, not unlike Kim's criteria, founders that are building their businesses in secondary geographies, things like that. Yeah, that's us.
Great. We will hear from you all one more time. If you'll let us, would love to go through a couple of everyone's, biggest success stories or case studies that they have seen with this type of financing. So we will start going back to the beginning with Wayne.
Okay, so I think what Kim and team asked for was something that was more in the upper end of the middle market. So I picked Hunt to Killer for a couple reasons. One is, it had been, largely founder bootstrap driven, had grown for several years, and when we came in, they were basically looking to expand their sales and marketing with some form of non-dilutive capital. Like so many other people, they had heard about it somewhere, no recollection of exactly where they heard about it, but that they thought this could be interesting. And as we dug in, we really liked the business. They're selling effectively two things, both a in-store, kind of murder mystery game product and an online, and also in sort of the play at home variety. So pretty interesting model. Has recurring revenues in some parts of the business. Other parts are more traditional CPG. But basically when we came in, they were growing like crazy, and we're looking to do something, that they could just grow the business a lot without traditional equity. So we did the deal in mid-19. You might argue we were lucky because, I don't know, 6 months later, COVID hit, and everyone was at home playing games. And so the company grew like crazy. Number 6 on the Inc. 5000 list, 2021, they had north of 50 million in revenue. And 150,000 active subscribers. This is a little bit dated, so I'm sure it's different now. But what's interesting, and the reason I picked this one, as you can just see, I think the initial loan was about 2.5 and expanded up to 5. So we grew with the company, number one. And number two, probably the next to the last bullet here, which is that they raised another venture round late 2021, $10 million, classic conventional venture model. And there's a lot of people out there think that if you take RBF, then you'll have a hard time raising venture. And that's just not the case. We have seen dozens and dozens and dozens of our companies go on to raise venture. If you have a good business, people will write checks for venture capital. They won't write checks for kind of halfway businesses or ones that are struggling. But if you have a good, solid business, there's generally capital. Now, in times like we're in today, that's probably going to be less than it was in 2021 and 2020, given the market that we're in. But beyond that, it's just, it's not been an issue for people to have an RBF product in there. I mean, they could have paid it off, but it's still in place and they pay every month, just like everyone else in the portfolio. And this was a deal where they were very happy because they waited a number of years, got a lot of capital behind them before they actually raised that next round. And, turned out to be very successful for them.
Thanks, Wayne.
Yeah, I think that one would be different from all the others. So.
All right, Kim, back to you.
All right. This company that we're going to talk about and this case study is a great example of a good company that was able to transition and leverage revenue-based capital to become a great company. They were a service-based business focused in the life science area, where they had a unique service that helped companies that were being evaluated for FDA compliance to help with their controls and systems to make certain they were compliant. And this particular entrepreneur, she actually was in business for well over 10 years, wanting to make the transition from being a great, a good service-based business. You could say it was using technology. She was a certified SharePoint solution provider, but wanted to have her own IP in order to grow her business. It was a Black woman-led business. You can see by their certification. So she had the different certification, worked with a number of great companies prior to starting her business, but beyond getting, low six-figure bank debt, could not get access to, significant amount of capital to really create her own IP platform. And so we were able to provide her with this revenue-based financing. And we actually have done follow-on financing. So now she has her own IP platform. And the other thing that's unique from this, not only did she grow her business, significantly. I mean, she's on pace to do 5 million this year, but her valuation process changed from being a typical EBITDA, service-based business to now being a true core tech company where she's valued based on her top line capital. But we've had the opportunity of being a great growth partner to her. She helps her companies, like, for example, Moderna, get through the regulatory compliance with her, control supporting systems. And then with the traction that she's had, she's leveraging this to go into other market segments, including insurance and others that have this similar regulatory controls.
Kim. Okay, Keith, back to you.
All right, thank you. This company's name is not actually Company One. They just didn't authorize us to use their name. So sorry about that. But it is a really cool company and I think a great story. So this is a company in the ed tech industry that had a mobile payment and digital wallet product and platform for the K-12 education market. We got to know them when they had just under $3 million in revenue. And the CEO was really trying to figure out how to grow. The CEO had actually been around the block, so to speak. He had been through Techstars before. He had taken VC money. He had a pretty good understanding of fundraising and how that process works. And he got to a point with this business where he was like, you know what, I don't want to raise additional equity or any equity right now because I won't be able to get the terms that I'm looking for. Debt doesn't make sense for me, traditional debt. Short-term debt doesn't make a lot of sense for me because it's extractive and it's going to make it hard for my business to grow. So he went around trying to figure out what else might be out there. And that's how we ended up finding him. He reached out to us. So his big problem was actually he was kind of, and I think this is not actually very uncommon, but he was kind of in the way of growing the business, right? He was the guy that the growth plan really relied on, and he hadn't had a chance to really build out that core team that would be the growth engine going forward. He definitely had product market fit. I mean, he almost had $3 million in revenue and he's growing 40% year over year. He just didn't have the right team in place. And so once we met him, we had a couple of conversations, dug in, realized this is a really great business with a lot of potential. And helped him see not only that he needs capital, but also how he can use the capital. And so we provided him $500K. And alongside that money, we actually helped him think about and then execute a plan around recruiting. He brought in a growth team with a VP of marketing, a couple of new BDRs, and one or two new salespeople, and just blew it out of the water. So one of the things that we helped him think about was he was going and selling to individual schools, right? Selling just to the buildings and sometimes even to individual teachers. And once we started talking with him, we thought, well, you could grow a lot bigger, a lot faster if you change your strategy. And so what he ended up doing was going after school districts and then in fact, state level sales. So he would close like an entire state, which really jump-started his revenue. So within a year, he was up to 7.6 million in revenue. So that's just enormous growth. And he, it's because he was able to take that money and really invest in the right team and the right strategy. And he had earlier said, I don't want to raise money. I don't want to raise any equity because I don't like the valuation. I know I'm not going to like the terms. Once he got to that $7.5 million revenue mark, he was able to go out. He raised his Series A. This is just one of those companies that he's going to have an enormous outcome at some point. For as long as he wants to run that business, I think he's going to be pretty successful. That was a pretty special circumstance. Not everybody can go from 40 to 270% growth, right? That's just enormous. But what we see generally is once we've provided funding, we see an average of about a 50% increase in a company's growth rate. So if we meet them and they're doing 30 or 40, we see them, go to 45 or 60% growth. Once an entrepreneur has the capital they need and the strategy in place, then they can really run and build their business.
Yeah, what a cool story. Thanks for sharing, Keith. Okay, BJ, back to you.
Yeah, this is an example, much like Keith's example. This company wouldn't really allow all this private information. I thought it was kind of important to show a lot of the specifics about this company, because this company is a bit of a roller coaster ride, as so many startup companies and companies in general are. And so I think the roller coaster ride here a little bit is a good example of where RBF can come in at times. So this is an ad tech company that was started in 2011, raised $20 million in venture capital, was wildly successful, grew to 60 million in revenue by 2017, over 6 years, with 5 million in profits. And then their business became invaded by outside forces and competitors that eroded the business down to the point where, as of 2021, that $60 million revenue stream had shrunk to 3 million. They'd lost a bunch of money, but they'd also come out with a brand new offering that was growing quite rapidly, about 50% year over year, and had grown up to about 12 million in revenue. So there's the company. They've raised 20 million in VC. The founders have already been diluted. The existing VCs, the last round of financing was in 2016. They don't have any money to go put any more in. They're tapped out. The founders don't want to get diluted. Nobody wants to have a long-term, equity investor come in and make them go for another like 5 years for an exit plus. So revenue-based financing was actually a really good fit for these guys. They wanted to go put their foot on the gas and grow the new product they had even more rapidly. And so it's Bixby with a company that was headquartered in the US, technically US parent company, but a lot of the technology development such, the original founders were in Israel. So we provide a $3.5 million loan. It's a relatively low multiple compared to some of these, but we also received a warrant, which is something we do sometimes. And company is totally taken off. So they're now at about a $25 million run rate. The new product is killing it. The old product is basically dead. But the company can go on now and exit whenever they want. And so with RBF, right, they can go and they can exit the business whenever they want. And they've gone from, an investment for the founders and the VCs that was going to be amazing to being a complete crash and burn to them really working hard to resuscitate it. And now with some capital, they can go and build it up again and sell it off. And so the goal is to really go and look at a strategic sale in the next couple of years once they've built the value of the business back up high enough. But it's a little bit of a unique situation. I think it's something where RBF can come in and play a part where there's kind of a story there, and yet a story that led to a company not wanting dilution and not wanting long-term equity investors, and yet wanting growth capital. And this is something that happens more often than you might think from the outside. Every story an entrepreneur will tell you about how their company went up and to the right. But as we all know, no company really just goes up and to the right. Typically, they go all over the place. And this one's a bit of an extreme example, but it's an extreme example that fit in. It's sort of an interesting example too, riffing off a little bit what Wayne was saying about companies raising venture capital after we fund them. This is one where RBF came in after venture capital in a strange sort of way, but I would totally reiterate what Wayne said. When I was at Lighter Capital, we were funding 150 companies a year, and we actually got to the point where in the early days, call it like 7-8 years ago, VCs did look at RBF a little bit squirrely, but they came to kind of love it. And we actually got a lot of the most active VCs in the country came to us at Lighter Capital and said, we went through our portfolio and looked through this, and you guys are actually the most frequent institutional provider of capital before our Series A investment. Like, we should be partnering with you. And so I think it really flipped over the past decade or so from RBF being a little bit strange to RBF being something that VCs see all the time. So I think if you're a founder out there and you're thinking about RBF as something you do before a VC, I wouldn't worry about it at all. Almost all VCs out there have seen this and know it and like it, and they love the fact that you've been able to build a business in a disciplined way without dilution.
Great, thank you, BJ. Okay, Melissa.
I just I think most of us on the call can remember what it was like to be new. It helped that I was an equity investor prior, but in the beginning there was this definite side eye that somehow this was some kind of predatory capital that was going to mess things up. I would completely double down on BJ's assertion that being a smart capital operator and showing that you know how to diversify your capital stack today is an asset. I have a deal now that's adjacent to a $2.1 million equity round. and we're in for a $500,000 on the straight equity contract, and everybody's happy with it, and the founders are happy too. So I think we can officially, there's not many things we can say for certain. I think we can put the concern that future investors, future equity investors, you may be prohibiting yourself from taking future other kinds of capital when you sign an RBF deal, but that future equity investors, whether you want one or not, will not turn you down because you showed that you were a good capital navigator and got your business into the zone. Really interesting to see all these different examples. I think Kim and her team asked me to pick something that wasn't SaaS, because you heard lots about SaaS. So this is a company, and I saw someone ask a question about South and Southeast. This is an Atlanta-based company, and I think quite interesting because it shows the flexibility that that an RBF model has when you don't need to count only on exits as a way to create value for your investors. So Everlasting Love is an integrated 3PL, fancy word for distribution and management for other e-commerce brands. In particular, ELL is the only Black-owned 3PL in the country, and they have developed specifically to service Black-owned and women-owned e-commerce brands, specifically recognizing that those companies may be disprivileged in the market and have to work twice as hard to get as far as others. And they also are a retail solution as well. And this is a good example of a company that isn't necessarily an obvious unicorn in venture scale language. So for a company like this, it can be difficult to raise capital kind of in between a very first small round and a later stage round, because you can't really paint the picture for who will buy it right away. But a lot of its value, both its value to create kind of wealth for this team and for their community, but also for these brands. But it's also turning out to be a really great business as well. So for this team and for me, this example exemplifies some of the flexibility where you can decouple your outcomes from having to have an exit, and also decouple your exits from being hyper dependent on a company's ability to raise future follow-on funding. You kind of can really liberate yourself from those constraints and zoom out and say to yourself, is this a business that I believe can be generating $20 million, downstream in a handful of years? And for me, the answer was definitely yes. And also another example of why for my fund, we want to be less transactional and lower volume. There are downsides to that that we can discuss on another day. But in this case, this company, as they were really strong operators, but as first-time founders and first-time founders who are building this company without the benefits of coming from networks of privilege, where there was a ton of sort of free information about how to build their businesses, being able to spend 3 to 5 years with this company, providing both market-facing support, but also deep support in the C-suite, and helping them just strengthen the core and build the business is just probably the primary reason why I'm still a professional investor. So this is why I chose this company. So use them; they're amazing.
Thanks, Melissa. Sorry, I think I messed up my screen sharing. Can you guys still see the screen?
Yeah.
Okay, great. Well, I believe that is the end of the speaker portion. So we would love to move on to some Q&As if you guys don't mind. We have a few that were submitted beforehand that Casey and I will quickly walk through. They're just for the group. So whoever feels like jumping in, feel free to jump in. And then we will hopefully have some time to get through a good portion of what is in the chat as well.
By the way, Bella, I've added all those questions to the initial questions that you received, so you can just go off that document.
You put them in the same document?
Yeah, I just added them.
Okay, great. Okay, so first question, I guess this is specifically for Kim and maybe for Melissa. Assuming an underserved small business has been earning over $1 million for over 18 months with predictable, provable revenue flows for the upcoming year, what are the top 3 reasons that something like Founders First or Rev Up would pass on funding them?
I would say that the strength of their revenues is important, as well as their gross margins are important as well. We want to make certain that the company is set up for success, so the profitability of that. And it may not be that it would be a total pass. It may be providing them some guidance around their gross margin, making certain that they don't have a significant amount of like MCA debt, The reality is that, a lot of diverse-led businesses, because there's not a angel network or friends and family around to finance them, that sometimes MCA debt can make it such that they are not able to service those areas. And so many times, if a business is in that scenario, we will give them some guidance around perhaps in 90 to 180 days, they could be able to be positioned for that, to take advantage of that. So it might not be not a no, but not now. And those may be some of the reasons why, but welcome Melissa's take on that.
Yeah, all those things. I mean, growth rate is really important. I mean, I think part of what all revenue-based funders are leaning into is the future growth curve. So we have to understand what's your potential in the market. Not all companies can grow infinitely, right? So that would be something that we typically look at. Again, because we're not a transactional institution and are making so few investments per year, we are almost using some diligence measures that are more like what I used when I was an equity investor, which is, am I impactful? Are my dollars impactful? Is my team impactful? And will we make a meaningful difference in the trajectory of your business? And if not, then I'm not the right investor for you. So another reason why we sometimes take a pass on a company is that we just look at that company and honestly don't believe that we are either our cash or our cash in combination with all the other things we bring to the table is really going to make a meaningful impact in the company's future. But then all the other things, growth rate, margins, growth curve, it's difficult to answer the question without asking a few more questions, but I think that's kind of it in broad strokes.
But I will add, just like the example that I mentioned for onshore, that sometimes as far as the growth trajectory, when a company has capital, they may be able to go, we've seen many times a company may be able to go from a growth rate of perhaps 20% to 60, 75, 100%, because they now have access to capital that they otherwise wouldn't have.
Yeah, and I think in that case, it is a lot about the team. And that, again, that's kind of an OG thing that is a little different than transactional based funding that's looking just at your base business metrics. I think anytime you're a strategic investor, you're looking to see, does the team have the capacity, the leadership capacity to turn those resources into that growth rate, right? So Kim has seen it, I have seen it. I have also not seen it. I've seen plenty of companies who think all they need is a little more money and everything will be great. And then you discover downstream that no, they just don't have what it takes to build something scalable as a team. And that's part of fund management, right? And that's part of the risk that we take is that they don't suss that out.
Thanks. Yeah, that's all great context. Certainly what we're all looking for on the revenue-based finance side. Here's a good one. Can you use or include financial projections to qualify for a loan for revenue-based financing? Or maybe more broadly, how are projections, financial projections, used to evaluate a business?
Who are you asking, Casey?
Oh, so for the group, yeah.
I'll just say in our case, it's very important because almost to what Melissa said, we have to really believe and realize that the company is going to grow at a growth rate that makes the product make sense. Having said that, I don't know, 99% of people don't hit their forecasts. So we look at all forecasts with a great amount of skepticism and we haircut them. We build in metrics into our deals that if we haircut them too much, that, they get some relief on the other side of that in terms of their growth. But generally speaking, it's one of the most critical pieces of evaluating and diligencing a deal. It's also probably one of the things that gets you thrown out quickly when people come through with, oh, we're going from 1 million to 22 million to 180 million to 600 million. I probably won't even return the email because it just shows a complete lack of credibility. And so for us, having someone who's thoughtfully put a set of projections together with, a lot of reality baked in is absolutely critical.
When I look at projections, it's very similar point of view. Yeah, projections are like a joke. Whatever you say, I'm going to dial them back inside my brain, which is fine. I was a venture investor. We relish obscene, unrealistic projections. But I think what is important if you're considering revenue-based funding is that you really do need to understand your underlying economics. You need to understand the cost drivers of your business. You need to understand, and I need to understand what your real margins look like so that I can design a deal that's going to be healthy for the company, right? So I think in all cases, I think when I was an equity investor, projections mattered a lot. I needed to see it, really feel like this was just going to be big enough so the juice was worth the squeeze. I think today when I look at it, I'm really trying to understand how a founder sees their business and how history supports that point of view. So when I look at your trailing 12 months, P&L, I'm trying to understand, is the story you're telling me about how you're going to grow and kind of what happens in your business, do the numbers substantiate that? Or could there be some misalignments that we need to work out together? And then certainly just pragmatically, I'm looking to understand to make sure that my revenue contract is going to fit inside your business in the future, right? And make sure that maybe you're secretly a much lower margin business than you think that you are. Well, then I might want to design a deal that takes that into account so that I'm not putting you in a position where the obligation of that revenue return, over the next 4 or 5 years, isn't going to be something that's going to cause troubles for the business. So I think it's definitely a shift, less about projections and more about the underlying economics of the business and the unit economics of the business and kind of understanding the cost drivers and the outcomes of that.
Yeah, I'll just jump in on that as well and echo what Melissa said. It's less about the projections than it is about the underlying economics of the business and also how the business has done over time. So we kind of look at it like, how have you been able to grow your business so far? And past performance is not necessarily a predictor of future performance, but it's generally pretty close in my experience. And so we think about that and we look at the underlying economics, and that's how we end up designing our deals. We look at projections as a data point, but it's not something that is we never hang our hat on that as sort of the reason to fund a company or not.
I think these are all good points here. I only have one other thought, which I think is a lot of times confusing for entrepreneurs. I think entrepreneurs think they've got their equity projections, and when they go and start talking to revenue-based financing providers, they go give the equity projections, and you're like, just don't do that. Give your actual budget, like what you really think you're going to be able to do, because then you can speak from a base of reality more. I think RBF providers, at least in my experience, are looking a lot more at reality than what's the hope for the future that an equity investor is. And especially considering a lot of times RBF, we're cutting a lot smaller check. You can't often shoot for the stars the way you can with equity. And so it's less about kind of selling the sizzle. It's a little bit more about selling the sanity. Kind of to Wayne's point of you got to show us something realistic. Someone's going to go to $100 million in 2 years from $2 million this year. It's just you're killing your own credibility. So, if you've got multiple projections, which listen, as an operator, I always had multiple projections, right? And you've got multiple ones you're kind of balancing off. Choosing something that's more on the realistic side, that's going to show how you can use that capital to truly grow and build a meaningful business is really what I think most of us want to see. I'm at risk of speaking for everybody here, but I think that's really what most of us want to see.
Yeah, thanks everyone. That was a great collaboration. It definitely makes a lot of sense. We have a couple people that have raised their hands. I think we're able to call on them. So first, Leah, did you have a question you wanted to ask?
Yeah, so my question was about D2C or B2C e-commerce advertising funding to create subscription revenue. Do any of your funds focus on that or allow for that?
So I think what you're thinking is sort of like a Clearco, very short term. No, as far as I know, no one on this call does that. I have e-commerce companies in my portfolio that use that tool as part of the integrated capital approach. I think again, it's always dangerous to speak for everybody on a panel, particularly because we have such different models. We never invest into any one thing. When we're investing into a company, we're investing into a set of goals, a set of objectives, and a plan. And it's never, the answer is never, we're just going to help you buy ads, right? So we do invest into B2C companies. It's about 30% of our overall portfolio, but not in the same way that I think you might be asking about, which is, sort of Wayflyer or Clearco, which are much shorter turnaround. So where our deal horizons are 4 to 6 years, Clearco is 6 to 12 months, and a much different consequence if you're wrong. So we're investing into strategies that might take a little longer, right, to generate revenue. Maybe not as patient as equity, but I don't think anybody here is specifically running that kind of short-term apparatus, but I'm generally supportive of those tools when integrated appropriately into a capital stack and when you have confidence around the patterns that you're investing into. But I don't know if there's anybody else here who does, well, I know Decathlon does some D2C, but in general, probably not the way you're thinking about it.
That's right. That's not the way we think about it.
Great. And then next we had Lucia, apologies if I pronounced that incorrectly, that raised their hand.
You're on mute.
You might be on mute.
Maybe next.
Okay, maybe we should move to Dorian, who raised his hand. Or-
Thanks. I put 9. Can you hear me? Good.
Yes.
I put.
Nope, not anymore.
All right.
Here you go.
There you go.
I put 9 questions into the chat room. I won't ask all of them. So, but here's 3. One is 3 quick ones. How do I get your contact information? Because I've got a half a dozen deals. One of them is in Israel to show you guys. The second is, where do you get your money from? And are you looking to raise money? And then the last one is there a secondary market for any of these types of deals, loans? And if not, are you interested in them? I got 6 more, but we'll save those for the future.
Love the enthusiasm.
You can write me on the Israel deal, obviously. It's bj@ibispikes.com.
Yeah, I'm Melissa. Oh, sorry, I thought you were done.
Go ahead.
Oh, no. Are you going to answer the question on secondaries?
Yeah.
Okay.
Second question: where do the funds come from? I think that I guess I'll try a general answer here for all of us, so we don't have to go through one by one. I think on this panel, I think I know enough about things here. You've got a huge variety of overall funding structures of investors coming in to provide capital that ultimately all of us as managers are managing and providing to the end startup companies and such. Here you've got everything from like sort of called specialty finance structures where there are specific vehicles put together, oftentimes that are using some amount of debt and leverage. You've got traditional GP LP structures, and you've got a huge mixture of those sizes and such, or of those kinds of structures and stuff as well. So I don't want to steal everybody's thunder here, but you've got a huge variety of the fund structures here, I think, represented. Anyway, I'll stop with that and let others speak.
I think that you did a great job with that.
Yeah, you kind of
got it,
covered
BJ.
it.
Yeah.
I can't answer for everyone in terms of the way my deals are written. We don't actually have a there's no paper. We don't have a debt component, but we don't sell our deals on secondary markets. I think it can be done, will be done. Some people do it. It can be very exciting. It doesn't always have to be bad. It's just in my particular case, our fund doesn't have any secondary market for our deals. We own them from birth to completion, and for better and for worse.
Same with us.
Yeah,
Same with us.
I forgot about that question, but I don't know a single revenue-based financing provider that sells their paper.
Nope.
Not in the traditional sense of like selling it off like a mortgage-backed security or anything. As of the market right now, it's hard to find a loan servicer that will actually service RBF. In fact, I'm sure a lot of the people here have had capital providers who've asked about that problem and said like, hey, if things don't go well, can you find somebody else to service each other's or service a loan? And I suspect the answer probably lies on this panel, because someone here would end up servicing the other person's loans. Anyway, point being that revenue-based financing is still, from a back office perspective, complex and unique enough that it's frankly a little bit one of the secret sauces of everybody on this panel. And so it's really hard to find somebody on the outside that understands how to manage these instruments and how to work with the companies, right? Because the whole design of this is that you're creating a debt instrument or debt-like instrument that has got equity components to it where it's aligned. So by its very nature, the relationship with the companies is a bit complex and productive and complex, but one that's really hard to just kind of sell off to an outside investor entirely like it was a mortgage.
Great, thanks. And I know we have somebody, one other person raising their hand. Let's get Randy in here. I think we should have time for at least one more question.
My question is, how long does the average process take? Somebody like us, we have an opportunity to open up a second school in September with 100 students, but having the income to do that is insane. And our growth was, we've only been in business 2 years and we've gone from 180K to 3 million K. So nobody will lend. So
we're about 30 days from chat to check. That's the way I
Okay.
describe it. But again, this is another example where there's a huge spectrum here. There are transactional investors where you can get an answer in 3-4 days. And then our diligence process is, I am the chief chooserator. I have a partner who chooserates with me, but we don't have an investment committee, right? So everyone's a little bit different. But honestly, the slowest part is when you send my deal to your lawyer and they blow you off for a few days before they get you red lines. And then how litigious is that? But again, we're longer than a transactional provider. Often some of those can go super fast, but still shorter than most traditional diligence. When I sit on the diligence committee and venture, a little quicker than that. But yeah, usually if I say from chat to check in about 30 days, assuming that everything goes well and we don't uncover anything weird along the way that requires a big pause.
Yep, and Keith here, we're about the same. Typically from the first conversation to funding is 3 to 4 weeks.
thank you.
Similar for Founders First, about 3 to 4 weeks.
Every time I get on a panel with all you guys, I want to be like, bitch stole my dress.
All right.
Great. Well, we have one more hand raised, so maybe we'll try to go through one more question quickly before we say goodbye.
Thank you, Bella. Much appreciated.
Yeah.
I'm trying to see if any of you do revenue-based equity, and if so, kind of describe what you consider that. And then the second part of it is, one of you did mention that you do take warrants, but can you talk how often the deals do have some sort of upside or specifically an equity component in it?
I have a repurchasable equity deal in my toolkit. I don't use it that often. We typically write straight revenue contracts, but we have it. The basics, and this is Bryce from NDVC sort of really pioneered this model and made a lot of those documents public. But essentially, at the onset of the investment, we purchase a percentage of your equity, kind of commensurate with what the last valuation was. Then you repurchase that equity back through your revenue payments over time, sometimes with a residual kicker. So that liquidates, in the event of some kind of acquisition event or some kind of exit. And then in terms of upside, I would probably less than 10% of my deals do we have any warrants. So BJ can talk a little bit about how that has worked out. There are some, we do focus a lot on companies that are good candidates for mid-market acquisition. As it presently stands, it's a good outcome for me just as a revenue investor. Usually accelerates that return and really it's a good outcome for everybody without equity even being involved. But sometimes these warrants are good when you're taking extra risk with an earlier stage company, wherein you may find that the revenue portion of the deal may not be as interesting on the upside as a small percentage of the company should it go through an acquisition event. But primarily, while we have repurchasable equity, the primary driver of value for us and our investors isn't a 1% hanging tail on that deal. It is the liquidity that's created by the revenue contract. Mostly, I also just hate being an equity investor anyway. So I made a big deal out of leaving that. So then to find myself back in the world of, waiting for Godot in hopes that somebody will exit, just don't want to, I don't think for any of us, the ability to capture some additional upside, is like it juices things. But the primary driver here are companies that can have productive revenue growth and return the vast majority of their value to our funds through revenue, not through equity. I
would echo that. We've never done a redeemable equity deal. I don't know, 10 years ago, there was a lot of discussion about it, maybe 11 years ago. The primary driver was actually tax efficiency, which it is, if structured right, immensely more tax efficient than our current structure that most all of us use. But it's probably immensely harder to sell to the entrepreneurs. And so there's a trade-off of velocity and friction in terms of actually getting deals done. I don't know of anyone who does it regularly. And we've never done one, have no plans to do one. We try to structure a deal that's fair with the right structure for the entrepreneur, and we all run forward and hope it works out.
I totally echo that. I've known several people have actually raised funds to try and do it. And they've just not been able to get any deals done because of that exact friction that Wayne's talking about. It is structurally like super, super brainy, intelligent tax-wise. I probably spent like a month looking into this a decade ago when there were a lot of people doing this. And after talking to several entrepreneurs about it and having them, on the phone go dead silent and like clear confusion around everything, you're like, this is not sellable. It will never take off. And unfortunately, didn't end up going that direction. So I think it depends a little bit too on what you mean by redeemable equity, because there are things like NDVC was doing, which unfortunately didn't go forward, but I think perhaps for different reasons than that. But there are still a lot of innovation, I think, in the space left. I think fortunately what you're seeing with this group and in playing in various types of the market and a little bit different structures and all kinds of things are models that are working. And broadly speaking, I think they're a little bit similar, but I think there's a lot of innovation left in RBF. And by RBF, I still mean a little bit more like longer term growth capital RBF happening, where angel investors could use it and combine it with less cash return, a little more equity emphasis, but maybe less dilutive in the early stages of entrepreneurs. There's a lot of innovation, I think, left to go on it. But for right now, I think you're seeing that this model that's using it much more like a debt instrument with some wacky alignment aspects to it is really what's worked the best in the market.
Yeah, and agree completely. And just to put some icing on the cake, we don't and haven't done any sort of redeemable equity kind of deals. They're complicated for entrepreneurs to understand, but they're also really complicated for the investor. And in terms of warrants, we did warrants on the deals that we did when we first launched, but we haven't done that now in probably a year and a half or 2 years. So we're just straight revenue-based financing across the board.
And the interesting part, I'm sorry, just to, on your point, one of the spirit here is creating more optionality, not less. It's not that a warrant is bad or a warrant is good, or I think what the goal here is to try to diversify the capital toolkit so more entrepreneurs have a shot at success. And so I try, like even myself, to remind myself not to get too reactive to anybody else's model, because really so much depends on the alignment between that deal and that company. And I think that's one of the interesting things about cutting yourself free from the constraints of there's actually much less flexibility in most of the equity models. And when you do have flexibility, it's typically in the investor's favor, not the founder. So there's nothing wrong with any of these things. It's just really about having optionality and being able to take that toolkit to get the job done that you want to get done.
Yeah.
Great. Thanks, everyone. Well, I'm going to pass it to Kim to finish it off, and really appreciate all the insight. It's been great.
Well, thank you. This is our second year doing this, and it's always such a pleasure to be in the company of such great subject matter experts in revenue-based financing. And our goal is to have this be an alternative way for companies to build wealth, build value, have alignment with entrepreneurs so that they can do this and grow their business. So thank you, and look out for the third edition of this installment, where you'll see some more innovations and how this is helping build great small and medium-sized businesses to something that Melissa mentioned. We believe in the power of what we call it founders versus zebra companies. You can build some really great companies that are up to 100 million, which is the area that Wayne has played in the mid-market. just the flexibility and optionality of this as a funding vehicle. So thanks so much for taking time to learn more about revenue-based financing and how it's not an idea, it's a practice that's funding hundreds of and soon thousands of businesses across, not just in the US, but internationally. It's versatile. It's versatile. So thank you, everyone, and look forward to connecting with you all soon. Take care. Good
Thanks,
night.
Kim. You're the best. Thanks, everybody.
Right.